The market is currently closed, meaning we are looking at the final numbers from the latest full session on Tuesday, May 19, 2026 at 4 p.m. Eastern Time. Rezolve AI closed at exactly $2.43 per share, marking a decline of 2.41% during regular hours on a heavy trading volume of over 11 million shares. If you looked strictly at that baseline number, you might assume this is just another struggling microcap stock slipping beneath the waves of a hyper-competitive software sector. However, the real story here is completely hidden from the surface. While everyday retail investors are dumping shares based on short-term price drops, deep-pocketed tech giants and sovereign enterprises are quietly moving in from behind the curtain. Just a few days ago, Tata Consultancy Services, a massive global firm with over $30 billion in revenue, formed an unprecedented alliance with Rezolve AI to implement their software systems at scale across global retail networks. That is an enterprise validation that rarely happens to a $2 stock, creating a massive mismatch between how the market is pricing this equity and how the corporate world is valuing its underlying technology. The general expectation surrounding Rezolve AI is that it is a high-risk, volatile, speculative asset that went public via a corporate combination and is bound to bleed out as larger tech giants dominate the software landscape. When people search for hot technology trends on mainstream investing sites, they typically flock to massive entities, assuming that small-scale players will get crushed before they ever find footing. The standard view is that a microcap company under a $1 billion valuation simply cannot establish a sustainable moat when multi-billion-dollar platforms are spending fortunes on tech infrastructure. The reality, though, is that the company is experiencing an exponential fundamental expansion that completely defies its depressed share price. In the first quarter of this year, they pulled in an unaudited $60 million in revenue, a figure that is higher than what they generated during the entire 12 months of last year. This represents an annual expansion rate that outpaces almost every large-scale enterprise peer on the market, yet the stock remains pinned near its historical lows due to broader market skepticism and fears over potential share dilution. To understand why this divergence is happening, we have to examine the aggressive daily trading patterns and capital flows that have characterized the last few weeks of action. The recent slide down to $2.43 is primarily driven by institutional caution regarding an active shelf registration of 37 million shares, which investors worry could lead to near-term equity dilution. When retail traders using popular self-investing apps see a stock price dropping consistently below its 200-day moving average, panic tends to take over, causing them to liquidate their positions through an individual brokerage without digging into the quarterly filings. This systematic selling has created a massive ceiling on the stock, completely overshadowing major milestones like their recent software suite launch on the Microsoft Foundry platform or their strategic asset integration with major European consumer apps. Institutional funds that utilize advanced analytical tools on an interactive brokers platform are carefully watching this volume buildup, knowing that a company growing its customer count from 50 to nearly 1,000 in a single year cannot be ignored forever. If you are managing your capital through traditional routes like Fidelity Investments, checking out standard online investing products, or tracking small-cap software metrics on the Robinhood app, you are likely noticing that smaller technology plays are experiencing severe valuation compression. Ever since major reports show that large-scale infrastructure providers were experiencing fluctuating client acquisition numbers, the entire tech sector has faced intense scrutiny over its actual monetization capabilities. Investors are demanding immediate proof of profitability, and they are punishing any entity that trades at a premium price-to-sales multiple relative to the broader software ecosystem. Rezolve AI has found itself caught directly in this crossfire, trading at a premium multiple that makes traditional value screens flag it as overvalued, despite its 80-fold operational expansion. It is a classic example of a market that is pricing an equity based on general macro pressures rather than individual operational execution, leaving self-investing enthusiasts stuck in a difficult spot where they must choose between current price momentum and underlying financial data. Let us step back for a moment and look at exactly how this business functions and what its actual corporate model looks like. Rezolve AI operates as a cloud-based software provider that focuses entirely on what the tech industry calls agentic commerce. This involves creating highly advanced, specialized software engines designed to automate, verify, and streamline online retail transactions at an enterprise scale. Unlike basic conversational interfaces that simply provide product recommendations or answer basic customer support questions, their core platform allows large retailers to run complex, multi-layered digital transactions instantly with near-perfect accuracy. Their proprietary technology layer specifically addresses the massive problem of data inaccuracies and processing errors that currently cost global online retailers billions of dollars annually in lost sales. By providing an independent, highly verified processing architecture, they allow large businesses to integrate advanced transactional tools directly into their existing digital storefronts without having to re-engineer their entire back-end systems.
The financial historical records show just how rapidly this model has shifted from an experimental concept into a high-powered corporate engine. Back in 2024, the firm was bringing in a modest $2 million in total revenue, acting primarily as a niche technology developer trying to find an anchor in a crowded market. Fast forward through the audited 2025 financial statements, and that top line surged to $46.8 million, backed by a massive annual recurring revenue run rate that proved their enterprise software licenses were gaining serious traction. This phenomenal operational surge culminated in their current full year 26 corporate guidance, where management firmly reiterated that they expect to clear over $360 million in revenue while reaching consistent baseline profitability without needing to raise additional outside equity capital. For a company that only achieved its very first single month of positive net income in December of last year, maintaining a 66% gross margin while scaling at this speed is an incredibly rare financial feat. Comment below how many shares of Rezolve AI you currently hold in your portfolio. This type of severe structural divergence between high-speed revenue growth and a sinking equity value is exactly the kind of setup that creates massive long-term debates across online investment forums. While some prominent analysts at specialized firms have put out bold 12-month price targets as high as $15 per share, the day-to-day equity action remains completely dictated by shorter-term technical liquidations. Investors managing their personal accounts through automated setups like Schwab Intelligent Portfolios or browsing specialized investing sites are increasingly faced with a stark reality where standard microcap stocks are treated with extreme suspicion, regardless of their underlying fundamental performance. The overarching market narrative has become so heavily focused on a select group of mega-cap technology firms that small-scale innovators are frequently left completely disconnected from their true operational achievements, creating a highly polarized environment where only the most patient participants bother to look past the front-page ticker updates. Looking closely at the potential future scenarios, the midterm outlook for this equity is bound to be shaped by a fascinating mix of upcoming catalysts and structural risks. The absolute biggest operational risk hanging over the company is its ongoing highly aggressive activist campaign to acquire Commerce.com. The corporate leadership team has been fiercely pushing for this combination, distributing detailed presentations at major industry conferences and openly criticizing the target company's board for implementing defensive measures like a corporate poison pill. If Rezolve AI successfully forces this merger, it would instantly create a massive consolidated digital platform boasting over 60,000 independent digital storefronts and an immediate combined revenue run rate exceeding $700 million. However, if the target board successfully blocks the acquisition indefinitely, Rezolve will have to rely entirely on its organic client acquisition pipeline, which could cause a near-term slowdown in the hyperinflated growth metrics that current investors are banking on. Furthermore, the broader macroeconomic environment poses an undeniable challenge to smaller software developers trying to maintain their market valuations. If general capital costs remain elevated, institutional desks utilizing professional setups like the Interactive Brokers trading platform will continue to favor cash-rich corporate giants over cash-flow-negative small-cap names. Even though management has clearly stated they have enough current liquidity to reach baseline profitability without diluting existing shareholders, any unexpected macro shock could force them to tap into their active shelf registration, which would instantly trigger another wave of selling across platforms like the Robinhood app or via individual Fidelity brokerage accounts. The primary battleground for this stock over the coming quarters will be proving to the broader financial world that its 66% gross profit margins can translate into sustained positive net free cash flow on a corporate level, effectively forcing short sellers to abandon their positions. When you look back at everything we have covered, the core of the story always returns to that central tension between market perception and corporate reality. The market is looking at a volatile $2 software equity and pricing it as though its recent operational surge is a temporary anomaly that will quickly fade under competitive pressure. The corporate reality, however, shows an organization that has expanded its enterprise user base 19 times in 12 months, secured deep architectural validation from global tech services giants, and is tracking toward hundreds of millions of dollars in highly profitable software revenue. For anyone navigating the current landscape of self-investing, whether you are building a long-term retirement basket through specialized Fidelity IRAs or making short-term adjustments on a mobile trading application, identifying these deep operational disconnects is the true key to understanding where structural value is hiding. The day-to-day fluctuations will undoubtedly remain highly erratic, but as long as the underlying corporate metrics continue to validate the technology's enterprise adoption, the current market narrative will eventually be forced to reckon with the undeniable weight of financial reality. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.